Welcome to the Golden Truth video programming. Welcome to our next episode. I'm Dave Kranzler, and with me is my co-producer, lawyer extraordinaire John Titus. And today I wanted to go into the Barclays London Gold Fix censure, I guess you want to call it, or fine. I call it a wrist slapping. Essentially, as everyone probably knows by now, an options trader, what they're describing as an exotic options trader, was manipulating the gold market right around the time of the London Fix, of which Barclays is one of the committee members. And the Financial Conduct Authority, FCA, which is essentially England's version of FINRA. It's a self-regulatory organization. It's a membership, its members pay dues, and its members are all of the financial markets community over there. It's not part of the government. And essentially what this situation was, in my opinion, was nothing more than a wrist slapping designed to offer up just an anecdotal evidence of manipulation to try and get the regulators off of Barclays' back and off the back of the London Gold Fix. Essentially, in my opinion, what happened here was we have a whole file to convict a serial murder, and the serial murderer was convicted of jaywalking. I didn't really think too much about the details of what exactly went down until I read James Turk's interview in King World Network, KWN blog. I encourage everyone to read that. James Turk is one of the leading gold market experts, and he's one of the few guys that I actually make sure I read everything that he puts out. A Barclays trader sold an option that would pay the buyer $3.9 million if the London Gold Fix, the price gold was fixed at, was above $1,558.96 on June 28, 2012. After the fixing process had started, based on the existing bid and offer of bars, the fixing was moving up very close to the $1558.96 payout price. In other words, Barclays was exposed to a $3.9 million loss if the fix was priced at $1558.96 or higher. This exotic options trader took, I have 130 bars on this, he took somewhere between 100 and 150 bars, and these were bars that are physical bars that the trading desk did not own and had no intention of making delivery on. He submitted those bars as being for sale, and the reason why he did this was to try and influence the price back down away from that $1558.96 level. The price started to drift right back down, and literally a minute later the trader pulled the bars. As a result of this fraudulent conveyance of gold bars, was the London Gold Fix was fixed at $1558.50, 46 cents below the payout point for the entity that had the gold options that would have paid out $3.9 million. In other words, Barclays avoided having to make a $3.9 million payout as a result of the fraudulent offer of gold that the trading desk never had the intention of delivering, that type of thing. You see what's going on here. This type of thing goes on all the time. I guarantee you every trader at Barclays connected to the gold market is involved in schemes like this. So without further ado, I thought it would be interesting for everyone to hear about my co-producer John's perspective from a legal perspective.
Well, thank you, Dave. You're right. My perspective is a little bit different than yours. You're an investor and an analyst, and I am a lawyer and a litigator. So my angle on it is a little bit different than yours, but I do agree with your central conclusion that this is a whitewash by the FCA. If you look at the FCA's opinion, there's a couple things that jump out to me as a lawyer. One is that this allegation by the FCA, and really conclusion by the FCA, concerns one day of trading in 2012. And that's really what the opinion by the FCA should be limited to, but it isn't. On the very first page of the FCA's opinion, what you see is that the scope of time covered by the FCA's opinion is 9 years. It runs from 2004 to 2013. So to the casual observer who sees a $26 million fine for behavior by Barclays that basically stole 3.9 million pounds from their clients, it might look like the fine is a lot bigger than the misconduct. However, when you put it in perspective of 9 years and realize that essentially there are 2,000 or 2,500 trading days in that time, and that this is going on all the time, you realize right away that the 26 million pound fine is essentially zero. It's not, it doesn't even really count. It doesn't rise to the level even of a tax. That's the first thing, that the scope of the FCA's opinion is far, far broader than the drop in a bucket misconduct at issue here. The second thing to notice is that the FCA's conclusion is that Barclays was engaged essentially in negligence, that they didn't exercise sufficient control over their conflict of interest policy, et cetera, et cetera. But when you look at the underlying facts described, that Barclays went out onto the market with gold that they didn't have for the specific purpose of capping the gold price, not only capping the gold price, but to relieve their own investors of 3.9 million pounds, the factual background described by the FCA itself sets forth a blow-by-blow black letter case of fraud, and yet the conclusion is that Barclays has done no more than engage in garden variety negligence. It would be like saying, well, Charles Manson was guilty of intentional infliction of emotional distress. That may be true, but that vastly understates what went on here.
Thank you, John. So let me get this straight. What you're saying is that as a result of this agreement, Barclays cannot be prosecuted for any gold market manipulation accusations in the London gold market from 2004 to 2013.
As a legal matter, that's not entirely correct because, as you noted, the FCA is not a governmental body. It is not a court. It does not issue binding authority. However, as a practical matter, the FCA will never go after Barclays again for any misconduct in the time window provided, that is from 2004 to 2013, because they'll simply say, well, we've already covered this. Look at this agreement. It says right on the very first page of the agreement, or the very first page of the opinion that issued by the FCA, this covers Barclays and what they're doing with the gold fixing between the time of 2004 and 2013. As a practical matter, they'll never revisit this again, and Barclays got away with not even a wrist slap.
That's truly incredible. I hope this video presentation was helpful to understand exactly what's going on with the Barclays situation. My feeling has been from the beginning that despite the fact they closed down the silver fix, and they'll find something to replace it the banks can use to manipulate over there. I do not think they're going to close down the London gold fix. And if they do, they'll transform it into something else that will enable them to manipulate this market. They make too much money manipulating the gold market. One last point, I'd like to remind the viewers that I do offer stock research for sale on my website, investmentdynamicsresearch.com. I'm just getting started on this. I've got 2 reports up on junior mining companies. One of them was up almost 10% today. I've had some very good feedback on it so far. I've actually had some feedback from some institutional investors who have offered me some ideas for enhancements. And when I get around to putting those into my future research, I'll probably be raising the price a little bit. I'm also currently working on another very, very undervalued junior mining stock situation and a home builder idea for any of you who want to short the home builders, which I think is a great short opportunity right now. So that about wraps it up. And that, my friends, is the golden truth.